Hello, welcome to the capital gains tax tutorials. My name's Philip. In the previous videos, you would have seen some calculations on capital gains on real estate properties and also some information on small business capital gains concessions. However, I'd like to take you back to the principles of what is a capital gain, how do you determine capital gains tax, and are you liable to pay capital gains tax on selling of your assets? Well, first things first, capital gains tax was introduced effective 20th of September 1985. So if you purchased any assets such as shares or real estate property investments. That also includes vacant land. If you've also purchased units in a unit trust, these all, if they were purchased prior to 20th of September 1985, and you made a very good profit on selling these, then you do not need to declare any capital gains. However, anytime on or after 20th of September 1985, you purchased any of these types of assets. And there are a number of other assets that are subject to capital gains, such as collectibles, artwork, jewelry, antiques, personal use assets, such as boats, furniture, household items that you use for personal enjoyment. If you purchased any of these categories of assets on or after the 20th of September 1985, then you will be liable to capital gains tax, and you will have to declare either a capital gain or loss in your individual tax return, or whatever entity you are trading under. You will need to declare a capital gain or loss there. Now, with that, there are certain methods in working out a capital gain. One method that you can work out a capital gain is using what we call an indexation method. Now, I'll show you what the indexation factors are, because that's what you'll be using in order to calculate capital gains. So if you can see this screen here, this screen has a lot of numbers. So that's based on consumer price indexes for each quarter, and that's where you use the indexation method. However, to be able to use the indexation method, you need to have either purchased the asset on or after 20th of September 1985. So the indexation commences from this quarter 1985, and purchased it, well, you would have had to have purchased it between 20th of September 1985 and September 1999. So indexation was frozen for capital gains tax purposes in September 1999. However, the consumer price indexes continue to update, but you won't be able to use these to work out the capital gain or loss using the indexation method. So how to index? Okay, when you sell, so let's say you sold a property somewhere in September 1998, for example. So there's an indexation number in September 1998, and you purchased it, say, in June 1990. So go back. So you've got September 1998, 121.3. You've got June 1990, 102.5. So you do take 121.3 divided by 1102.5. Your index factor is 1.1834. Now, what do you do with that? You multiply that by the purchase price of your asset. So you get the price that you paid for your asset, and then you multiply it by that factor, 1.18. That gets you what we call your cost base. However, the other catch in using the indexation method is that you have to have held the asset for at least 12 months. If you held it for less than 12 months, you won't be able to use the indexation factor and the index method. So to be able to use the indexation method, you need to have purchased the asset between September 1985 and 1999 and held the asset for at least 12 months. Now, usually with this, if you many people have taken advantage of the indexation factors because it usually in the past, especially going back all those years, it provided them with a better result than a discount method. So the discount method is the next method that you can use, where you basically need to have held the asset for at least 12 months. That way, you to work out the sale price minus the purchase, and then you add on any other incidental costs relating to the purchase and sale. That gives you your cost base. You subtract it from the sale price. That gives you what we call a general profit or a gain on sale of the asset. And then the discount method allows you to reduce the profit by 50%. That's called the 50% discount method. However, this 50% discount method is not available for companies. So if you have a company, a PTY Ltd, or even an Ltd company, a limited company, you won't be able to use a 50% capital gains discount method. So unfortunately, companies are stuck with the overall capital gain on the asset. And then the third method is just what we call the other method. So the other method basically tells you that you don't qualify for indexation and you don't qualify for the 50% capital gains discount. So you'll use that basically if you've held the asset for less than 12 months and sold it. The only method available to you to work out your capital gain is the other method. Which is basically your sale proceeds minus the cost base of your asset. Now, what assets are subject to capital gains? Now, the tax office has outlined a detailed list of assets that are subject to capital gains. Perhaps the main types of assets are shares or units in managed funds. That's considered part of shares. Investing in bonds as well is considered part of shares. Real estate, so that's a investment property, a second property, or it could even be a block of land. So you could buy a block of land, and if in the event that you decided you won't build on it and move into the property once it's built on, unfortunately you have to declare a capital gain or loss on sale of the land when you do sell it. Now, the only properties that are at the moment exempted from capital gains is what we call your main residence. That's a main residence exemption. If you sell the house that you've been living in, pretty much for all your life, or if that's been treated as your main residence, you still need to declare that in your tax return as a capital gain. But there are exemption items that you can use. And one of those exemption items that you'll use is main residence exemption. And therefore, your taxable gain is going to be zero. But you do need to show to the tax office that you are putting that as a capital gain, but it's your main residence. Because bear in mind, the tax office has a lot of information these days on assets such as property, land, shares, units that you've sold. They have information on that, and it's expected that you declare correctly in your tax return, but you can apply certain exemptions if they do apply to you and if you are entitled to those exemptions. So main residence is an exemption. Now, there is talks about having granny flats and that sort of thing as a capital gains exemption as well. We'll keep you posted on that. Now, the other items are collectibles. Now, that can be artwork, jewelry, antiques, basically anything that's of a lot of value, and that is considered a collectible. It could be different sets of, antique cupboards or, antique furniture or whatever the case may be. Classic watches, that can also be considered as a collectible. Now, there are special rules in relation to collectibles. So if you'll bear with me for a few moments, I'll go through those rules. Now, you can still apply a 50% capital gains discount. That hasn't changed. The rule is, if you purchased a collectible for less than $500, you disregard any capital gain or loss. So that means if you bought a piece of artwork for, say, $495, and the person selling it to you says to you, oh, look, that's going to be a famous artwork, but and so on and so forth, and they've sold you. But by looking at it at first glance, it may not have appealed to you, but perhaps you like collecting paintings or artwork, and you purchased it for $495. Now, let's say you get it valued by a registered valuer and somebody who's very experienced in artworks and in valuing these things. They come to you and say to you, oh, how did you get this rare piece of artwork? This is valued at $10,000. And you're astounded. How can a painting or a piece of artwork be valued at $10,000? I don't know, and I'm not judging or I'm not putting down any artists or artwork, but if it's valued at that, then good luck for you. And if you end up selling it for $9,000 or $10,000, guess what? You don't need to declare a capital gain on it because you've purchased it for less than $500. However, if you've purchased it for $501, for example, you will be stuck with a capital gain on that artwork. But you can use the 50% capital gains discount method. Now, the other rule around collectibles is, and it's a pretty tight rule, any capital losses can only be offset against capital gains on collectibles. So if you have a capital loss on a collectible and you have a capital gain on shares and personal use assets, you cannot offset that capital loss on collectible. And in fact, the more advanced tax return systems, it won't let you do that. It won't allow you to do that. So you're stuck with a capital loss, and a capital loss can be carried forward into how many ever years that is required. Again, if you've purchased a collectible for more than $500 and if you've sold it for less than $500, you still have to declare a capital loss on the collectible. And unfortunately, you cannot offset it against any capital gain on any of the other categories of assets. Okay, the other type of asset is what we call a personal use asset. Now, there are exemptions. Motor vehicles, motorcycles, and your main residence are exempted from this category of personal use assets. So a personal use asset can be, for example, a boat. It can be a household furniture, household items that you perhaps purchase, for your personal enjoyment. That's what can fall under a personal use asset. Now, the rule around that is, if you purchase a personal use asset for less than $10,000, any capital gain or loss is disregarded. So you do not even declare a gain or a loss if you purchased a personal use asset for less than $10,000. And chances are that the majority of personal use assets, whether they're in a single parcel or whether they're in a set, would be less than $10,000. However, if you've purchased a personal use asset for more than $10,000, you then need to declare a capital gain or a capital loss in your tax return. However, if you have a capital loss on a personal use asset and you have a capital gain on shares or real estate, you can offset these against each other. Now, if you happen to have a capital loss carried over from previous years and you have a capital gain in the current year, the way this works is what you do first is you work out the total current year capital gain. So let's say you had a current year capital gain of $10,000 and you've held all of these assets for more than 12 months. But you've had a prior year loss of $7,000 capital loss, no loss on collectibles, but you've had a capital loss on all other items from prior years of $7,000. So you offset these two against each other, giving you a current year gain of $3,000. And then you apply a 50% discount method. So when you work out that the capital gain is $3,000, 50% of that, $1,500, is your net capital gain using the discount method after you have applied the prior year capital losses to your current year capital gain. Okay, so that's basically how you work out the principles of capital gains and capital losses. Now, just a final word on capital gains and losses. Now, if you have prior year tax losses, what we mean is obviously assessable income minus allowable deductions equals your taxable income. If you have a loss from a prior year, any net capital gains can be used to reduce the loss. So let's say you have had a prior year tax loss of $10,000, and in this financial year, you also had a tax loss of, let's say, $5,000. So that's a total loss of $15,000 to carry forward. However, you've had a net capital gain of $10,000. So this capital gain of $10,000 is going to be used and is going to be accessible. However, you can offset your prior year tax losses against the capital gain, which means now overall you're only going to have a tax loss to carry forward of $5,000. However, it doesn't work like that with a capital loss, unfortunately. You cannot use the capital loss to offset any of your other assessable income. You are stuck with the capital loss for as many years as is practicable, or as many years as you're as you are continuing to purchase and sell assets. So you're stuck with that loss for an infinite number of years, the capital loss. You can only use that to offset your future year capital gains. But a capital gain can be used to reduce your tax liability to zero if you have prior year tax losses that will cover that capital gain. So I hope you now know the principles of capital gains, what to do with a capital gain, what to do with the capital losses, and how each is treated. Now, obviously, tax on the capital gains is treated according to the tax rate that you would pay. So if you're an individual, you're taxed on your marginal rates of tax on a capital gain. If you're a company, your capital gain is taxed at 30%, or if you're a base rate entity, your capital gains is taxed at 27.5%. If you have a self-managed superannuation fund, and you've held the asset for more than a year, your effective tax rate on the capital gain is 10%, because it allows for a 1/3 for a discount method, and then another third off. So that's 10%. As you know, the super funds are taxed at 15% on earnings and capital gains. So in a nutshell, that's the principles of capital gains and capital losses, and how capital gains are declared and taxed in your tax return.